A 72-year-old Pakistani uncle living in New Jersey. He's had a green card for 14 years. He receives Social Security. He has a small pension. Every year his son files his taxes, takes the standard deduction, sends in the return. Done. That's it. Last year his tax bill was $3,200. But when I told him about the 3 things I'm going to tell you today, he refiled his 2025 return. And the result? That $3,200 bill dropped to zero. And on top of that, he got a $1,870 refund. And if this uncle had been claiming all 3 of these credits and deductions for the last 8 years, the total savings would have been over $47,500. This is not somebody else's money. This is your money, if you qualify. The IRS created these benefits for you. But the problem is nobody tells you. Not your CPA, not your son, not the TurboTax software. Today I'm going to explain all 3 hidden credits to you line by line, dollar by dollar, form by form.
My name is Mr. Zubair. This is US Visa News Daily, and this video could literally put thousands of dollars back in your pocket. Before I tell you about the 3 credits, let me explain why this is happening. Why millions of immigrant seniors in America are overpaying their taxes every single year. There are 4 reasons. Reason number 1, language barrier. Most immigrant seniors, whether they're from Pakistan, India, Bangladesh, Mexico, the Philippines, Nigeria, English is not their first language. Tax forms are already confusing for Americans who were born here. For someone who came to this country at age 55 or 60, reading IRS instructions can feel impossible. So they rely on their children or a cheap tax preparer, or they just use basic software. And all of these options miss the credits that are specifically designed for seniors. Reason number 2, fear of the IRS. I hear this all the time. I don't want to claim too much. What if the IRS audits me? Let me tell you something very clearly. These are legal credits. They are written into the Internal Revenue Code. The IRS wants eligible people to claim them. They have published guidance for seniors so people can understand the rules more easily. Claiming what you're legally entitled to is not a risk. Missing it is. Reason number 3, the recent tax law changed everything. A new federal law was signed and it introduced a brand new deduction for seniors that did not exist before. It went into effect for tax year 2025. That means if you filed your 2025 taxes already without this deduction, you may have left money on the table. And most immigrant seniors have no idea this change even exists. Reason number 4, tax preparers do not always specialize in senior credits. Most tax preparers, even the ones in your local community, handle hundreds of returns during tax season. They use templates. They don't sit down and ask, "Are you over 65? Do you qualify for Schedule R? Did you check the new senior deduction?" They just run the numbers and file, and you lose thousands of dollars because of a 5-minute conversation that never happened. Now, let me show you the 3 credits and deductions that can change everything. Credit number 1, and this is the biggest one, is the new enhanced senior deduction under the recent tax law. Here's what happened. When the law was passed in 2025, it included a provision that says if you are 65 years of age or older, you may now deduct an additional $6,000 from your taxable income. If you're married and both of you are 65 or older, you may deduct $12,000. Let me repeat that. This is $6,000 per person on top of every other deduction you already get. Now, here's the key. This is not the same as the older Additional Standard Deduction that seniors already received. That older deduction still exists for 2026. That older deduction is $2,050 for single filers over 65 and $1,100 per spouse for married filers. That hasn't gone away. This new $6,000 deduction is added on top of that. It stacks. So let me show you what a single senior over 65 can deduct in 2026. That means the first $24,150 of your income is completely tax-free, and for a married couple where both spouses are over 65, $4,700 of tax-free income. That is where the $47,500 number in the title comes from. If a married senior couple has been missing these combined deductions, the cumulative loss over several years can easily cross $47,500. Now, who qualifies? The IRS says you need 3 things. 1, you must be 65 years of age or older on or before the last day of the tax year. So for 2025, you had to turn 65 by December 31st, 2025. 2, you must have a Social Security number that is valid for work and was issued before your return due date. Now listen to this very carefully. If you are a green card holder, you have a work-authorized Social Security number. That means you qualify. This is not just for U.S. citizens. Green card holders are fully eligible. However, and this is critical, if you only have an ITIN, an individual taxpayer identification number, you do not qualify for this new deduction. The recent law specifically requires a work-authorized SSN. This is one of the changes in the rules that treats ITIN filers differently. Legal research groups and tax policy analysts have noted that these rules can create a stricter tax path for some immigrant filers who do not have SSNs. But for green card holders and naturalized citizens, you are eligible if you meet the other requirements. 3. If you are married, you must file a joint return. You cannot file married filing separately and claim this deduction. The law specifically blocks that. The phase-out, the full $6,000 deduction is available if your modified adjusted gross income is $75,000 or less for single filers or $150,000 or less for married joint filers. If your income is above those numbers, the deduction starts to shrink. It reduces by 6% of every dollar over the threshold. So for a single filer, the deduction completely disappears at $175,000. For a married couple, it disappears at $250,000. But here's the reality. Most immigrant seniors I talk to have income between $20,000 and $60,000. Social Security plus maybe a small pension or part-time work. If that's you, you get the full $6,000. No phase-out, no reduction. How to claim it? The IRS created a brand new form, Schedule 1A. This form did not exist before 2025. It's where you report the senior deduction, the tip deduction, the overtime deduction, and the car loan interest deduction. All new provisions from the recent law. Your tax preparer needs to know about Schedule 1A. If they don't, find a new tax preparer. This deduction is temporary. It applies for tax years 2025 to 2028 only. After 2028, unless Congress extends it, it expires. So, you have 4 years to take advantage of this. Don't waste a single one. Credit number 2 is one of the most overlooked credits in the entire tax code. It's called the credit for the elderly or the disabled, and you claim it on Schedule R, Form 1040. This credit has existed for decades. It is not new. But according to IRS data, fewer than 5% of eligible seniors actually claim it. That means 95 out of every 100 people who should be getting this credit are not. Why? Because nobody tells them about it. It's buried in the instructions. Most tax software skips it unless you specifically check a box, and most community tax preparers don't even know it exists. Here's how it works. If you are 65 or older and you are a U.S. citizen or resident alien, which includes all green card holders, you may be eligible for a direct credit against your tax bill. This is not a deduction. A deduction reduces your taxable income. A credit reduces your actual tax dollar for dollar. That makes it more powerful than a deduction. The credit ranges from $3,650 to $7,500, depending on your filing status. Here are the base amounts. The calculation step by step. Step 1. Start with your base amount based on filing status. Step 2. Subtract your non-taxable Social Security benefits and any other non-taxable pension income. This is important. If you receive $14,000 in Social Security and none of it is taxable, you subtract that full amount from the base. Step 3. Then subtract 50% of your AGI that exceeds $7,500 single or $10,000 married joint. Step 4. Multiply whatever is left by 15%. That is your credit. Real example. Let's say you're a 70-year-old single green card holder. Your AGI is $15,000. You receive $10,000 in non-taxable Social Security. Base amount $5,000 minus non-taxable Social Security, $10,000. Result, already negative, no credit in this specific case. But if your non-taxable Social Security is lower, say $3,000 and your AGI is $12,000, base amount $5,000 minus $3,000 non-taxable, SS equals $2,000 minus 50% of $12,000 minus $7,500 equals 50% of $4,500 equals $2,250. Result, negative, no credit. Now here's where it gets interesting. If your Social Security is partially taxable and your non-taxable portion is small, the credit can kick in. And for married couples filing jointly, where the base is $7,500, the math often works in your favor, especially if one spouse has low income. The income limits are, if your AGI is below these limits, you should absolutely run the numbers on Schedule R. Even if the credit comes out to $200 or $300, that is $200 or $300 directly off your tax bill over 8 years. That's $1,600 to $2,400 that you may never have claimed. Who can claim it? You must be a U.S. citizen or a resident alien for the entire tax year. Green card holders are resident aliens. You qualify, period. How to claim it? File Schedule R with your Form 1040 or 1040 SR. The IRS instructions walk you through the calculation line by line. Or, and this is my strong recommendation, use the IRS's VITA program or Tax Counseling for the Elderly (TCE) program. These are free tax preparation services for people over 60 and people with low to moderate income. There are thousands of VITA and TCE locations across America. You can find the nearest one by using the IRS Free Tax Help Locator online or by calling the IRS Helpline. AARP also runs free tax preparation through its Tax-Aide program. These volunteers are trained to look for Schedule R eligibility. Your community tax preparer probably is not. Credit number 3. And I call this the silent deduction because people claim the standard deduction every year, but they forget to add the extra amount for being over 65. Under current law, this has nothing to do with the new law. If you are 65 or older, the IRS gives you an additional standard deduction on top of the regular one. This has been in the tax code for years, but millions of seniors miss it because they or their tax preparer simply check the standard deduction box without adding the age-based bonus. For tax year 2026, the additional amounts are, and here's a detail most people don't know, if you are both over 65 and legally blind, you get this additional deduction twice. So, a single blind senior over 65 gets double the extra amount. Why do people miss this? Because on the tax form, there's a checkbox that says born before January 2, 1962 for 2026 filing. If you don't check that box, the software doesn't add the extra deduction. I have personally seen returns where a 70-year-old green card holder's son filed the return and never checked that box. 5 years of returns. That's roughly $10,000 in deductions that were never taken. And the fix is simple. If you missed it in prior years, you can file Form 1040X, the amended return, for the last 3 years and get that money back. Now, let me put all three together, the full picture for 2026. Single senior over 65, green card holder, income $35,000. Without these three benefits, the same person would owe approximately $2,600 in taxes. That's a difference of over $2,265 in 1 year. Married couple, both over 65, combined income $55,000. 0. A married immigrant couple making $55,000 a year if both are over 65 and they claim all three benefits can legally owe zero federal income tax. And over 8 years, the savings cross $47,500 easily. Now, I have to be honest with you because this channel is about protecting you. And the same law that gave seniors this $6,000 deduction, the recent tax law, also changed benefits for some immigrant filers. Tax policy groups have pointed out that certain rules can create different outcomes depending on immigration status and the type of tax ID used. Here's what changed. 1. The new senior deduction, the overtime deduction, the tip deduction, and the car loan interest deduction all require a work-authorized Social Security number. If you file with an ITIN, you are excluded. This affects millions of immigrants who are legally present in the U.S., but don't have an SSN. 2. Child tax credit rules were tightened. In some cases, the qualifying child may still have an SSN, but the parent's filing status and identification matter more than before. Some policy groups have warned that mixed-status families could see a reduced benefit. 3. There may also be new fees or taxes on international money transfers depending on the final rules in place and how the transfer is made. If you send money to your family back home, Pakistan, India, Mexico, the Philippines, always check the current rules before you send. 4. Education tax credits. The American Opportunity Tax Credit and the Lifetime Learning Credit now require SSNs. Students with ITINs can be blocked. 5. Premium tax credits for health insurance under the ACA may also depend on the type of immigration status and the documents used when filing. I'm telling you this because you need to see the full picture. The law gives with one hand and takes with the other. If you are a green card holder or naturalized citizen with a Social Security number, you may benefit from these new deductions. You should claim them if you qualify. But if you have family members who are on ITINs, or on TPS, or on DACA, they may need extra help understanding the filing rules, and that can affect your family's overall financial health. All right. Now, the most important part, what should you do right now? Here's your 5-step action plan. Step 1. Check if you already filed your 2025 return. If you filed your 2025 taxes and you did not claim the new $6,000 senior deduction, you need to file an amended return using Form 1040X. You generally have until April 15, 2029 to amend your 2025 return. Don't leave that money behind. Step 2. Make sure the age 65 box is checked on every return. Go back and look at your last 3 years of tax returns. On Form 1040, there's a checkbox that says you were born before a certain date. If that box is not checked, your additional standard deduction for seniors was not applied. File Form 1040X for each year it was missed. You can go back 3 years. Step 3. Ask your tax preparer about Schedule R. Specifically, say, I am over 65. Am I eligible for the credit for the elderly or disabled on Schedule R? If they don't know what Schedule R is, walk out. Go to a VITA site or an AARP Tax-Aide location instead. These are free and the volunteers are trained for senior credits. The IRS VITA locator is online at the Free Tax Help website. Step 4. Know your filing status and use it wisely. If you are married, file jointly. The recent law's senior deduction is only available on joint returns. Filing separately disqualifies you, and filing jointly gives you the highest combined deductions, potentially $47,600 for a couple where both are over 65. Step 5. Act before 2028. The new $6,000 senior deduction expires after tax year 2028 unless Congress extends it. That gives you 4 tax years, 2025, 2026, 2027, and 2028. If you miss all 4 years, you could lose up to $24,000 in deductions as a single filer or $48,000 as a married couple. There is no way to get that back later. Look, I know what it's like. You came to this country, you worked hard, you paid your taxes, you followed every rule, And now you're 65, 70, 75 years old, and the system is complicated, and nobody explains it to you in plain language. That's why this channel exists. US Visa News Daily is here to protect you. Not just from ICE, not just from CBP, not just from airports, but from the IRS too. Because losing money you're legally entitled to is just as serious as missing an important immigration deadline. Today, I showed you 3 credits and deductions. Number 1, the new $6,000 senior deduction under the recent tax law. Claim it on Schedule 1A. Number 2, the credit for the elderly or disabled. Claim it on Schedule R up to $7,500 directly off your tax bill. Number 3, the additional standard deduction for seniors. Check the box on your Form 1040. Combined, these 3 benefits can save a married senior couple up to $47,600 per year in deductions alone over 4 years. That's potentially tens of thousands of dollars. Share this video with every uncle, every auntie, every parent, every grandparent you know who is over 65 and holds a green card or is a naturalized citizen. This information could change their lives. If you want me to make a video about how California and New York state taxes are different for immigrant seniors, type state tax in the comments. Like this video. Subscribe if you haven't. Hit the bell icon for notifications. My name is Mr. Zubair. This is US Visa News Daily. Disclaimer: this video is for educational purposes only and does not constitute legal or tax advice. Please consult a qualified tax professional for your specific situation.